This is what Peter Schiff has to say about what's coming for you. Yes, and most importantly, for the investors out there. But what does all of this mean? Well, it means that it's time to wake up and realize that the game has changed. You see, the strategies that worked in the past are not going to work in this new investment landscape. We can no longer rely on the Fed to keep inflating the bubble and driving up asset prices. The air is coming out of the bubble, and there's no stopping it. Yes, it's true, but we don't want to keep repeatedly talking about this inevitable doom. Instead, let's look into what we can do now. How do we navigate through this uncertain and anxiety-inducing time as investors? Well, the first step is to understand the root of the problem: inflation. You see, it's not just a temporary blip on the radar, but a long-standing issue that has been brewing for over a decade. The Fed's attempts to disguise it with measures like the CPI have only delayed the inevitable. Consumer prices are on the rise, and it's not just the CPI, but other measures like the PPI and CPI core as well. This inflation problem is becoming more apparent and is hitting us where it hurts. Yup, our wallets. The price of goods and services that we rely on every day are going up, and it's impacting our purchasing power with every passing second. But how did we get here? Well, part of the problem lies in our trade deficit. We've been importing goods from other countries and paying for them with printed money. This way of dealing with trade has further fueled demand without increasing supply, and has contributed to the inflationary hikes we're facing now. And what else? To make matters worse, the government and the Fed made some seriously goofy moves in their monetary policies during the pandemic. Instead of contracting the money supply along with the economy, they flooded the market with stimulus checks and other bailout money. While this may have provided some short-term relief for Americans, it created a massive increase in demand without a corresponding increase in supply. This, coupled with the Fed's money printing, has created a perfect storm for inflation. Now, you might be thinking about normalizing interest rates, right? But I would say that this tiny move could actually lead to a financial crisis worse than what we experienced in 2008. Yes, you heard that right. If the Fed were to let interest rates go to their natural level, we could be looking at a catastrophic collapse of the financial system. Imagine all the big banks that we bailed out during the last financial crisis failing, the stock market crash, and the real estate market collapsing. It's not a pretty picture, right? But that's not all. The private sector, including businesses and households, would struggle to service their debts with higher interest rates. And guess what? The United States government would be in the same boat, if not worse. They might even be forced to default on their national debt. And this applies to the same idea of the Feds not letting the interest rates go up and fighting inflation. Well, it's not that simple. You see, the Fed is caught between a rock and a hard place. They have no good options, only bad and worse choices. The bad choice is to let everything collapse by raising interest rates and fighting inflation. The worst choice, believe it or not, is to continue creating inflation to avoid the immediate consequences, but potentially leading to hyperinflation in the long run. And unfortunately, that's the choice they might end up making. So, what can we do as investors to protect ourselves and make the most out of this situation? Well, it's time to rethink our strategy and adapt to the new investment landscape. One strategy to consider is diversification. It's no longer enough to rely solely on stocks and bonds. We need to look beyond the traditional asset classes and consider alternative investments like real estate, commodities, and even cryptocurrencies. These assets can provide a hedge against inflation and diversify our portfolio, reducing risk. Another strategy to consider is value investing. In times of inflation, companies that can pass on the increased cost to consumers through higher prices may fare better than those that cannot. Look for companies with strong pricing power and a history of raising prices in response to inflation. these companies may be better positioned to weather the storm and maintain profitability. Now, after watching all of this, it may sound like a lot of boring economic parodies, but trust me, it's something we all need to be concerned about. This is not just some distant problem that won't affect us. It's hitting us right in our wallets and bank accounts, and it's only going to get worse if we don't take it seriously. Think about it. When was the last time you went grocery shopping? I bet you've noticed that the prices of everyday items like milk, eggs, and bread have gone up significantly. And it's not just food, it's also gas, housing, healthcare, and pretty much everything else. It's becoming harder and harder to stretch our paychecks and make ends meet. But it's not just the rising prices that we should be worried about. It's the ripple effects of inflation that can have a devastating impact on our economy and our lives. As prices go up, it erodes our purchasing power, which means we can buy less with the same amount of money. This can lead to a decrease in consumer spending, which can then result in businesses struggling to sell their products or services, and ultimately, job losses and economic downturns. And let's not forget about our long-term investments. Many of us have retirement accounts or investment portfolios that we rely on for our future financial security. But with the changing dynamics of the investment landscape due to inflation, our traditional investments lose value. The assets that have performed well in the past may not perform as expected in an inflationary environment, and this can have a significant impact on our long-term financial goals. So, you guys better educate yourselves about the current economic situation and understand the risks and challenges posed by inflation. Do keep in mind the steps we spoke about before. We need to be aware of the signs of inflation and keep a close eye on the Consumer Price Index and other economic indicators to check the extent of inflationary pressures. Anyways, in the end, we can no longer afford to ignore the elephant in the room: inflation. It's a real threat that is already impacting our daily lives and our financial future. But with awareness, education, and proactive financial planning, we can handle the risks and protect ourselves from the adverse effects of inflation. So it's better to take action now and safeguard our financial well-being for the coming years. I don't want to scare you, but the news we just shared is not exactly sunshine and rainbows. With 186 more banks at risk of failing, it's hard not to think about the possibility of another Great Depression looming on the horizon. Anyways, let's all stay informed, stay proactive, and most importantly, stay calm. Because no matter what happens, we'll get through it together. Thanks for watching, and until next time, take care of yourselves out there.